hardest decisions in investing isn't what to buy, it's knowing when to sell. And if you get it wrong, you could leave tens of thousands of dollars on the table. So today, my AI assistant Tiara and I will show you how to identify the signs that it's time to sell, regardless of whether or not the market is up or down, and how to make decisions that'll increase your chances of maximizing your returns. Plus, I'll uncover the worst pattern of behavior that most investors overlook, which could mean you're consistently selling at the absolute worst possible time. So let's get started here by hearing what my AI assistant Tiara has to say. Tiara, go ahead.
All right, we'll start with changes in company fundamentals.
Okay, that makes sense. We can start there. So when you invest in a company, you're betting on its future success. But what happens when that company starts to fail? So let's say that you invested in a small tech company that was all about smartphone apps. Then suddenly their latest app completely flops and their revenue just takes a nosedive. That's a change in company fundamentals, and it might be time to reconsider your investment. As an example, I felt a change in company fundamentals myself years ago when it seemed to me that Apple, which we all know, wasn't innovating beyond their smartphone. Then I realized I'm an idiot, and Apple is different. It's one of those companies that has a cult following and people will buy literally anything they put out, such as a $19 polishing cloth. Remember that thing?
Because who doesn't need a designer cloth to shine their screen? You meatbags would buy Apple-branded oxygen if they sold it.
This is the first time that I've ever been called a meatbag, so thank you, Tiara. Anyway, keep an eye on things like quarterly earnings reports, sales figures, and how the company's performing compared to its competitors. If you notice that there's a consistent downward trend, it could be a red flag, and you should really take a chance to look deeper.
Let's move on to our next point, achieving your investment goals.
Imagine you've been investing for years with a specific goal in mind. Let's say you've been saving up for a down payment on a house. Well, you set a target of $50,000 and your investments, they've finally grown to reach that amount. This could be the perfect time to sell some of your holdings and make that dream a reality. But here's the thing. Maybe you started investing for a house, but now you're thinking, well, renting isn't so bad, and now you're more worried about early retirement. There's absolutely nothing wrong with that. My cat is outside, of course, because why wouldn't she be? Get in here, get in, come on. That's what happens when I try to record during the day. It's impossible. There's nothing wrong with that. The key is to regularly check in with yourself and make sure that your investments still align with what you want out of life. Now, hitting your investment targets, it feels great, but what's next? Well, let's focus on a technique that keeps your investments healthy and aligned with your goals when you're, kind of letting them ride.
All right, let's talk about portfolio rebalancing. This might sound a bit technical, but I promise it's simpler than it seems.
If you don't know what this means, we'll make it simple for you. So think of your investment portfolio like a pizza, right? You've got different slices representing different types of investments. Maybe some stocks, some bonds, and some crypto.
Wait, Ron, did you just compare investments to pizza? Humans really will turn anything into a food metaphor, won't they?
Honestly, I thought it was a pretty solid metaphor. Kind of feel attacked right now. My point is that when you first made your investment pizza, you carefully chose how big each slice should be based on your goals and your risk tolerance. But here's the thing. Over time, some of those slices, they might grow bigger than others. So for instance, maybe your tech stocks, they're on fire and have grown to be a much larger portion of your portfolio than you originally planned. This is where rebalancing comes in. Rebalancing means selling some of your winners and buying more of your underperforming assets to get back to your original mix that you had in mind. Now, I can give you a great example of something that I had to do a few months back to illustrate this perfectly.
Story time. Introducing our host, Ron.
I bought 180 shares of NVIDIA in March of 2020 at $6.12 a share. Now, if you're wondering how I knew it would be the biggest stock on the stock market just 4 years later, I didn't. My dad told me about the stock back then, so I figured it was worth a gamble to, go ahead and buy it just to see what happens. Well, needless to say, it outperformed, which was great, but there was a problem because it had split twice since 2020. And because of that, it ended up being a massive position in my stock portfolio and I would gain or lose literally $10,000 to $15,000 per day based on NVIDIA's performance. That was too much for me. So as much as that company has done well, if the CEO was randomly hit by a bus when I held all that stock, it could have dropped 20% overnight. And I don't have the risk tolerance for that. I don't have the stomach for it. So I sold a third of it, and then I put a trailing stop on another third, basically making it so that if it dropped 10% from its highest point, it would automatically sell. And then I kept a third of it. Well, unfortunately, the trailing stop hit and I lost another third of it. So 2/3 is gone. I still have a third of what I originally had, but I cashed out just over $21,000 and I invested it in many other assets instead. Now this seems counterintuitive. Why would you sell your winners? Well, remember, it's all about managing your risk. By rebalancing, I can now sleep better at night and not worry about losing everything over some crazy, company-specific black swan event. All right, so now let's assume that you've mastered the art of rebalancing. So here's a $1 million question. What if there's a better investment out there?
Sometimes, you might find that there are more attractive investment options available than what you currently hold in your investment portfolio.
Obviously, this could be a great reason to consider selling some of your current investments. Now, here's why you might want to consider selling if other opportunities come about. So first is opportunity cost. By holding on to underperforming investments, you might actually be missing out on potentially higher returns elsewhere. Second is what's called sector rotation. So different sectors of the economy perform better at different times. So for example, tech stocks might outperform during periods of innovation, like what I'd argue is right now, while utilities, like power, water, etc., might do better during economic downturns. Third is there are emerging markets or industries. So new investment opportunities, they might arise in emerging markets or innovative industries. These could offer some really, really high growth potential compared to your current holdings. And fourth is changing market conditions. So as economic conditions shift, certain types of investments might become more attractive. So for instance, when interest rates rise, bonds might become much more appealing compared to dividend stocks. Remember though that constantly chasing the next big thing can lead to excessive trading and potentially higher costs.
Yeah, because humans are so good at not jumping on every bandwagon. I'm shocked, absolutely shocked.
All right, relax, Tiara. The point is that it's crucial to balance the potential for better opportunities with your overall investment strategy and long-term goals, while also learning to control your emotions as an investor.
So what about the factors that are unique to you? In our next segment of the video, we're diving into the personal factors that impact you.
All right, so now let's talk about those more personal reasons why it might be a good time to sell your holdings. Well, first, you're in desperate need of money, right? We all know that life can be unpredictable. One day you're kind of cruising along, everything's going well, and then bam, you're hit with an unexpected expense that requires a big chunk of cash. This is where your investments may be able to save you. So some examples of this would be, medical emergencies or job loss or urgent home repairs, just to name a few. When you're facing these situations, you want to be strategic about which investments you sell. So consider the factors like tax implications, potential penalties for early withdrawal, and how selling might impact your financial goals. Ideally, you'd have an emergency fund for these situations, and you wouldn't have to sell anything, but we all know that that's just not always possible. While you always want to keep all of your investments where they are if you can, keep in mind that an investment can also serve as a financial safety net when life gets really, really messy.
All right, let's talk about how changes in your personal financial situation can impact your investment decisions.
Your financial situation, it isn't set in stone. It can shift dramatically due to numerous life events. And each of these events can alter your financial goals, your risk tolerance, and investment needs. So for example, getting married might mean combining finances and really reassessing your joint financial goals. Having a child, it could shift your focus to long-term savings for education. Or, on a positive side, a big promotion might allow you to take on more investment risk for potentially higher returns. The key here is to regularly review your investments as your life changes. That f***ing dog inside. So what worked for, single you might not be ideal for married you with kids. If you have to sell off some of your investments because personal circumstances change, then just do it. That's okay.
Next, let's chat about how your risk tolerance can shift over time.
Often ignored or never really even identified because people just don't think about it enough, risk tolerance is a big deal when investing. So big, in fact, that I made a video entirely dedicated to the topic that I'll link to later in this video so that you can check it out. But your risk tolerance isn't set in stone. It can change as your life changes, and that's totally normal. There are a number of things that might make you rethink your risk tolerance. So first is getting older. So as you creep closer to retirement, you might start feeling a bit more cautious with your money. And that's totally fine and normal to think this way. Next is life events. So coming from someone, myself, who is married and has 2 kids and has had numerous times when I thought my business wouldn't survive over the last 10 years, I can tell you personally that life events happen and they really do alter your risk tolerance. Next is health changes. So if you or a family member face unexpected health issues, it might make you more conservative in your investments to make sure that you have enough to survive. And then lastly is market roller coasters. So the wild ups and downs in the stock market that can happen, well, they can really affect how much risk you're comfortable with. And the key here is to check in with yourself regularly and ask yourself if you're cool with, the level of risk that you're currently taking. If the answer is no, it might be time to chat with a professional and adjust your strategy.
Now that you've got a handle on your risk comfort zone, it's time to tackle taxes. This next part is important because it could save you thousands of dollars.
When you sell your investments, Uncle Sam wants his cut. That's no surprise to anybody. And it starts with capital gains tax. So the big one to watch out for is the capital gains tax. This applies when you sell an investment for a profit. So here's kind of a quick breakdown for you. So short-term gains, if you held the investment for a year or less, you'll pay your ordinary income tax. And for most folks, that's higher than the long-term capital gains rate. Now, long-term gains, which is when you hold an investment for more than a year, you'll typically pay 0, 15, or 20% depending on your current income. For most people, this rate is lower than the ordinary income tax rate. In terms of strategies to minimize taxes, so first, think long-term. So whenever possible, try to hold investments for more than a year to qualify for the long-term capital gains rates. Next, tax loss harvesting. So if you've got some losers in your portfolio, which we all usually do, you could sell them before the end of the year to offset the gains from your winners, which can help reduce your overall tax bill. Now for me, I always look in the last week of December of every year to see if I can sell some of the stocks at a loss to invest in other areas. And third is use tax advantage accounts. So investments in accounts like a 401k or IRA, those grow tax-free and tax-deferred, which can really help reduce your current tax burden. And I can't overstate how important this actually is. Dump as much as you can into your retirement accounts when you can. It really is the smartest way to invest if you want to go long term. Remember, taxes shouldn't be the only factor in your investment decisions, but they are definitely something that you want to keep in mind. If all this tax talk kind of makes your eyes go crossed, well, just speak with an accountant for help.
Hey Ron, you never told them the worst pattern of behavior that most investors overlook. Get it together.
Ah, yes. And this, ladies and gentlemen, is why Tiara is great to have around sometimes. So, recency bias is a common pitfall where investors, they focus too heavily on recent market events, which leads to poor decision making. And this bias, it could cause you to chase hot stocks during bull markets or panic sell during downturns. To combat recency bias, it's crucial to maintain a long-term perspective, diversify your portfolio, and stick to the predetermined investment strategy that you've created. Remember that the stock market, its history is filled with ups and downs, but over the last 100 years, it has averaged a 10% return each year. Now, earlier in the video, I mentioned a video that I had about risk tolerance, and I wanted to make sure that you knew of that video because it's a foundational investment pillar that I think everyone should know about themselves if they want to invest. And I actually love putting that video together, and you can go ahead and watch that right over here. And if for some reason you don't think that one's for you, that's fine. Click on this video over here because YouTube told me that you'd like it, and hopefully you do. But before you leave, as always, don't forget to hit that subscribe button to unlock financial success, one AI chat at a time. Thanks as always for watching.